It is Thursday, November 3rd. This is 0 days to expiration, and this is the final hour. The final hour to expiration. SPX, S&P. Oh, just reading something. Okay. All right. Today, we're going to talk about hedging and whether or not it is appropriate as retail traders, as we all are, that we hedge. And what does actually hedging mean? What does it mean from the traditional sense? And who actually are the hedgers? Why do you hedge? Are you hedging because, well, maybe you've overextended your strategy, and you need to put on an opposing trade to protect yourself from catastrophic loss? Is that more like a defensive measure, or can hedging be an offensive measure or part of the strategy, something that you use to actually make profit? And I know that it's a big topic with a lot of people, and they think they have an understanding of it, or they want to use it in such a way that they think that it is some sort of heady strategy they're using to make profit or to save themselves, or I don't know. Is it, first of all, offensive or defensive? I think that most people would think that it's a defensive move, but it's really most people that are putting on what they call a hedge is a defensive strategy to make up for the inadequacies of their strategy itself, and that it has gone wrong, and they want to try to fix it the best they can. And some people will actually claim that they could take this hedge and then turn it into a profit. Of course, it is always possible to turn it into a profit if everything goes your way and if your hedge is successful and all the stars aligned. Yeah, it is. But let's first talk about what hedging actually is and where it all originates from, and who are the primary hedgers in the market. Now, a lot of you probably are unfamiliar with what I'm about to tell you. You just hear the term hedge and you think that, oh, that's just a strategy that traders use. And I'm going to tell you that, yeah, it's a strategy that a lot of retail traders use. It's not a strategy that I'm aware of that many pro traders use. They either define their risk and play out the strategy, or they don't, and they accept whatever that is. They try to mitigate their losses. I guess you could call that hedging in some way. But once a strategy has failed, but they don't put the hedge on mid strategy just in case everything goes wrong. It's usually put on after the fact. You're in this strategy, everything seems to be going right, then it goes a little bit wrong and you get nervous, so you put on this additional play in order to change the profit curve, or maybe do something called gamma hedging. And I had another video where I talked about gamma hedging. There's also something called delta hedging, which is a very different thing than gamma hedging, but it's very similar. And as options traders, though, unless we're also trading with an underlying, we're not really able to do any gamma hedging or delta hedging, because first of all, we're trading the SPX and there's nothing underlying to trade. I suppose that if you had a large enough position, you could potentially do that with futures, or maybe even mini futures. That's a possibility. But generally, the sizes don't comport with one another. The size of your options trade versus the power that a futures contract will have in order to do that kind of hedging. And I'll talk about those in separate instances, exactly what is gamma hedging, what is the hedging, etc. But most people, they want to know that they can fix their trade and get out of it and be able to put on this magical hedge that will save them from ruin and maybe even turn it into a profit. So let's first talk about, well, who actually does hedging, and in the traditional sense. So hedging is really the purpose of a futures contract. And that's the dog. What are you doing down there, dog? Hedging was is really why futures contracts were created. And let's see. Hold on here. I have somebody that keeps on pegging me here. I got to find out what the hell's going on. I think someone's talking to me about a hedging strategy. Well, anyways, futures were really developed to help people who are in the cash market of a commodity to hedge their product from the time that they initiate a contract or with or engage in a contract with the buyer of their product and the time that they actually start with or I guess initiate the product, right, or create it. So, for example, a farmer grows crops and he starts the crop maybe 3 months before he's going to harvest it and then bring it to uh, you know the warehouse where they're going to buy it. But from the time that he invests all his money into the growth of that crop, the pricing of that particular commodity is set at some particular price on that day. Uh, and so he may have obtained financing and other things based on what that price is. So he has kind of this fixed baseline that he has to abide by. However, 3 months from now, he's going to have to harvest that product and then deliver it to the the grain silo or the processing plant or wherever it's going to go. And the price of the product itself may have changed between now and then, 3 months later. So what the farmer needs to do is he needs to hedge his costs with a future product, a future contract. And because he's going to be selling his product to a supplier or a mill operator or whoever it is, he has to sell a futures contract against what he's going to deliver. And so by selling that, what that protects him from is if price goes down, then the future contract will gain in value and thereby keep his overall investment steady state. He hasn't lost any money from the time from his expectation of when he started to when he delivered. So that is hedging. So hedging happens in the case where you have someone who's dealing in the underlying cash market or the commodity. In futures, it's referred to as the cash market, and wants to hedge their costs because there's a time lag and things can happen in that time. And the same thing happens on the mill operator too. They're going to buy that said product, and so they need to hedge their costs as well in that period of time. So they'll buy a futures contract in case the price of that product goes up. Now they've obtained this extra cash from their hedge, their future, and they can now afford it. They were planning on buying it at X, but now it's X plus 5, and then their future contract went up 5, and now they can afford to buy it. All of their accounting and everything is nice and tidy. That's what hedging is. That is actual hedging in a commodity market. And you can do hedging with all kinds of things. It can be all the different agricultural products. It can be it can be energy and oil or gas. It could be minerals. It could be lumber. It could be gold or silver when it's all of those things can be hedged, and they're there to help protect over the change of that product's price over time. That's why they call futures, because they're hedging you for the future change. And so that's what hedging is. Hedging isn't to save you from the stupid ass move you made in a trade, right? That's just you throwing good money after bad, because usually when you try to hedge or try to offset a loss, you've just incurred more risk. And because you were so stupid to have gotten in that situation in the first place, the chances are that your quote hedge is probably going to go against you as well, and you're going to lose on both ends. Right? So that in the retail sense of the word is what hedging is. It is probably the stupidest move that a retail trader can make because it is the fastest move to risk of ruin. All right, so now you know what hedging actually is. There are some people that can also hedge equities, right? And so if you have a very large account and you think that there could be some economic calamity coming, you could hedge your large stock portfolio with an equity future. So that is also possible. You can also hedge other different types of products, which may not be as physical as, let's say, corn or orange juice or something like that, or live cattle or whatever it is. But maybe it's a interest instrument like a treasury. You could also hedge against that. And of course, futures are also used to take delivery of said product. So if you buy a futures contract, that's what you're doing is you're buying that futures contract to hedge your position in something you plan on buying in the future. And if you allow it to go all the way to expiration, then there is a delivery aspect to that where you will take delivery of said product at the agreed upon price and of a certain quality and value. And that's what the futures contract also can be used for, right? And if you're on the other side selling it, then you're obligated to actually deliver that product. That's what futures are for. That's what hedging actually is. Hedging is not trying to save your ass on an errant trade. All that's doing is showing your inadequacy as a trader and putting yourself at greater risk than you were before. Usually, I mean, sometimes you might do a good job, and there are ways to do things that they call like gamma hedging and delta hedging, which are strategies, but they're more offensive strategies than anything else. They are adjustments to your trade that you future plan for, that you under certain conditions you do this, right? Um, and so though those are things that you can do. And our membership was asking about hedging and about other different products, and so because they hear other services out there saying that hey, they do all this hedging and they trade all this kinds of money and they're doing this and that and they're making $5,000 a week and blah blah blah, and come to find out that yeah, they probably do that, but they're using hundreds of thousands of dollars to make that money, and they also incur huge losses that that they're not reporting or showing. Heck, they're not showing their P&L at all. I show my P&L every single day. I update it every single day. Well, sometimes it takes me 2 days. So, but I update every trade that I do. So I am completely unhedged and showing you what I'm doing. That's what I'm doing. And my growth is steady as she goes. It's kind of stair step. I go up, go sideways a little bit, go up, go sideways a little bit, go up, go sideways a little bit. Every time a tiny little drop, and my drops are very minimal. But that all has to do with the strategy that we use, this asymmetric strategy. It is a super boring way to trade, but it's kind of like comparing the tortoise to the hare. The hare is just all harebrained and all over the place and taking ungodly risks and usually ending up losing. And what we're doing is slow and steady, concentrating more on our process than the outcome, because that's what works. And of course, I'll get criticized, and I have been criticized just recently by one of these hotshot, quote, professional traders. I mean, I know what it is. I mean, everybody has different strategies. There are those traders that are they're cowboys or just put caution to the wind, and and occasionally they'll make some good money, but then they also burn out in a blazing glory. And while they're doing that, I'm still going on. Super boring. Focusing on the process, not on the outcome. Not hedging, because hedging isn't in my vocabulary. Although some of my members have asked me about, and I thought I would introduce another type of strategy that I call a dynamic squeeze that they said is similar to what some of these other people are doing. And then I thought about it for a while, and I'm probably not going to do that. Now, there are some strategies though, that I can see would make a lot of sense. It's very difficult, first of all, to employ these types of strategies in a day, right? Because you have limited time to do the roll. You have you're a little bit um, tied up. You have fewer options when you're rolling in the same day, because a lot of people will roll to future dates where we're not rolling to future dates because we're trying to do everything that day. We don't want to hold anything overnight. So your rolling has to be very deliberate and very calculated and under only certain conditions and pre-planned, as opposed to something that you put on to try to save a little bit of risk. However, if you're putting on so much risk that you feel compelled to do that, then maybe what you should do, instead of spending all that extra time and effort, is figure out how I can define my risk so that I don't have to, quote, hedge, which you're not hedging. What you're doing is trying to fix a screw up. All right. I'm done with that rant. Where am I going to bring this now, Ernie? There's nothing else to rant about. All right. Uh, I'll say that this week has kind of sucked so far. It hasn't worked out well for us. Uh, 4 small losses last week, 5 medium to very large wins. So last week completely overshadows this week. But this week, it just hasn't worked out. And that's one of the reasons why we take super small risks, well-defined risks, right? Because we know that, and look, my losses aren't going to cause me to take a big dip or go into risk of ruin. Right now, after 4 straight losses, I'm only down like 1.5%. My max drawdown so far this year has been about 3.25%. And I have a strategy for what I do to handle drawdowns. Again, those drawdowns are really in the context of doing this sideways, step up, kind of sideways, step up, sideways. Those sideways moves tend to be certain types of markets. And I can often identify those markets relatively soon, but sometimes it can take a week or two before you understand exactly what's going on and how you're going to adjust your strategy. Now, we don't really necessarily adjust our strategy. What we do is we're playing some mathematical probabilities here. In the market is chaotic, the market is random. However, within that randomness and that chaos, there are streaks. There are clusters of things that happen over and over again. And that's what these, sometimes having maybe a few losers in a row, are all about. And so there are really just a couple of strategies that you have in order to try to get yourself out of that. Now, one thing for most traders that are in a high probability strategy, they can't take these multiple losses, because if they do, they'll come to risk of ruin, because their margin on every single individual trade is so big that a few losses could potentially give them a 20-30% drawdown. Where for me, I would have to lose like 20 in a row in order to, maybe more, to get that kind of drawdown. In fact, this past year, even though I have averaged about 6.5% gain per month, there was a streak in there where I only won 6 trades out of 29. All right, so that's an abysmal 20% win rate. However, I only drew down 3.5% during that time. And then after I employed my strategy, I came out of it and made another new high in the market. So that's, I guess that is a form of hedging, but the hedging really is hedging the risk, and it's not putting on additional risk to hedge risk, because every time you put on a hedge, you might be hedging your risk here, right? But then you're adding risk here, right? So here, this goes up a little bit, but over here, it goes down, way down. So you've helped things on this side of the equation, but what happens if price decides to go over here to this side? So all you've done is you've shifted the risk and potentially opened yourself up to the risk that is now even bigger on the other side. So we don't do that. We don't do that at all. Instead, our risk is small on both sides, like this. And then the middle is like huge. Small on both sides. So what we do to hedge the risk is that we just make both sides smaller, or even smaller, and maybe a little bit narrower and a little bit closer to price. That's all we do. We stay with basically the same strategy, just shrink down a little bit. That way that while we're in this natural streak, it's not affecting us any more than is necessary. Of course, we figure out what our normal risk is, and even that, even after a great number of losses, still isn't enough to affect us in any material way. And that presents a particular advantage or edge that we have over other strategies. And that is that because our risk is so small, because we are not attached in any way attached to any of our trades, that we have complete detachment from our trades and what we're putting on, it never affects us. It never causes that lizard brain to go into flight or fight type mode, and we don't get panicked. There's none of that at all. And instead, we're able to keep that level of detachment and be able to make clear-headed, logical, rational decisions. Unlike most people that are in the high probability stratosphere, they hit a big risk, and it's now catastrophic, potentially risk of ruin. Risk of ruin is generally defined as losing half of your account. And that sends them apoplectic. It's like the poker player on tilt starts making really bad decisions, starts going from doing really well to all of a sudden just falling off the cliff. That's what being on tilt was. I think the term originally comes from old school pinball machines, because if you banged it hard enough from your frustration, it would tilt and then the game would be over. But poker players, that's generally a term that they use for them, that they get a couple of bad beats and they can't understand how that possibly could have happened to them because everything was going so great, and it frustrates the hell out of them. Their amygdala starts spewing all kinds of hormones, and they become panicked and start making really bad decisions, try to overcompensate for the bets that they made and try to win back the money, and that puts them into a deeper hole and then perpetuates the whole cycle. Same thing with traders. Same exact thing. The way you mitigate that is that you don't allow yourself, first of all, to get into that kind of situation where you have those large risks. You take small, even-handed risks. And if you do get into a streak, then all you do is you squeeze down and shrink down even smaller, or you don't trade at all. Now, last month, I had one of the weeks was a bad week, so I only traded once out of the 5 days. Mitigated the risk. Now, I don't know if I would have won. I don't know. I really don't know. But it seemed like the pattern of the market was the same that was giving me trouble. So I decided, hey, I'll just avoid it. And I couldn't find, according to our strategy, really good trades. So I just decided to sidestep them. In one case, I didn't take it because I was just too busy with the business, quite frankly. So maybe 3 out of those 5 trades, that's what happened. But those are 2 possible things that you can do. You can simply not play the game, or you can play much smaller. And that is a valid way to hedge your risks. As a matter of fact, that is probably the best way, because that is the least destructive way. And it's the way that will keep your mind in the game and clear. Putting on a hedge, a quote hedge, does not clear your mind. It does not put you at ease. Everything has to go right on that hedge. It has to go in your direction, because if you put on the hedge and then it goes immediately against the hedge, you're up Schitt's Creek. And your amygdala is pumping away adrenaline and other, I don't know if does the amygdala pump adrenaline? I think it pumps out some kind of hormone, or it takes over and causes other things to pump out these bad hormones. Right? So there you go. That's the truth about hedging. Hedging is actually for professionals in the cash market, not for retail traders that don't know their ass from their elbow of what hedging is, and are willing to put on way too much risk than is necessary, because that's what they think they must do by putting on high probability strategies. They don't understand the caveat, but they say, well, I put stops in. Well, market can go right through that stop. Nothing stopping the market from going through your stop. Sure, it will work most of the time, but when it doesn't, that's the time when you needed it to work, and it won't hold it. You put defined risk, ain't nothing gonna ruin your defined risk. That's it. It's defined. By definition, your defined risk is defined. A stop does not define your risk. And the cool thing about defined risk is that you can hit your defined risk and you're still in the game. Price can come back. Once you hit a stop, game over. Done. Finito. Yeah. Two very, very different ways of looking at the market. All right, so here I am. I have talked my ass off for 30 minutes, and I have not yet acknowledged those people that are in the chat room. Sorry about that. We'll do that. We're going to do a roll call right now, and here we go. Hey, how you doing? Hello, hello, the double hello. And Rob Fresno's here, and we'll do. He's always here. Yanis Anagnostu. And I'm sorry if I screwed up your name. Yes, I am also Greek, but I haven't spoken Greek since I was 8 years old, and I'm very bad. But thank you very much from Greece, from Athens. Riza's here. How you doing, Riza? And Jim S. Tim Dodds. Good afternoon, Tim. And we have Dan Smith, as always. Don H. Something Federal Reserve. Yeah, well, that has been a thorn in our side this week, for sure. And guys here, I also worry about sloth brain on days like today. So slow, I'll do something stupid. Yeah, I understand that. On slow days, on most days, I mean, we don't have, our strategy doesn't require us to be like right on top of the monitor all day. We can set alerts that will tell us when we're in the area to be concerned. That's a good time to start working on other things that will help you improve your overall performance. Maybe do a little research, touch up or review your journal. Anything like that would be a good thing to do. Go do some push-ups, run around the block, take the dog for a walk. That's probably good too. All right, the Greek Bandit. 2 Greeks. Scalping E-mini NASDAQ on a 30-second chart is my new favorite way to trade. Okay. He's this is a spam. He's spamming me. So you know what we do with spammers? We ban them unless they can give me a good reason not to ban them. Because they're not here to talk about what we want to talk about. So I'm sorry, even though you are the Greek Bandit, you're not my kind of Greek. You are banned. Sorry, there are very few reasons why I would ever ban somebody. One of them are those stupid sex things that come on every once in a while. I have to ban those, and then there are the others that are trying to sell a product in my house. Sam is here. How you doing, Sam? Sam, I am, and Robert Hill. Nice to see you. Rob Bablega is here. Nice to see you. And Chona Tucson. I don't know if I'm pronouncing that right, but thank you for coming. Jin Russum. Greetings from West Texas. I was in, I guess it would be East Texas a couple of years ago. I was down in Houston and went down there for the rodeo. That was just when the coronavirus outbreak was happening. I had just left. I remember actually I was at a conference on Grand Cayman, an ESG conference, when and that was in February. I think February. Yeah, it was an ESG conference where all of these multimillionaires and billionaires came from all over the world and came down to see Gina Davis and Bears, what's his name, that mountain guy, and then a whole bunch of other people, and they were all gathering there to pledge their billions of dollars to ESG. And so I was there trying to get a handle on what the hell they were doing, where the money was going for a client of mine. Where was I going with that? Because when I came back on the plane, that's when they announced these lockdowns were happening and everything. And so everyone started getting scared. And then the next week I went to meet with the client to talk to him about the trip. So I met him down in Houston because he owns a few hotels down there. And we went to the rodeo, and we heard that somebody at the rodeo had corona, and we were all worried that we were going to pick it up. We were wondering, well, should we sit here and eat our Texas barbecue? We did. We didn't care. And we escaped safely, even though there was a coronavirus bandit there. You just banned the bandit. Yeah. Well, look, I mean, I could unban him, but there has to be a damn good reason. But to come on to my platform and try to sell his shit, screw that. Right? We don't put up with that. All right, let's check out the market, see what's going on. I don't know if you like this this view here. I got like the green screen there. I used to put the stock ticker back there, but you do have a nice view of my pool table there in the background, right there. And then my backyard. There's my backyard. So let's go to the charts. It's over there. All right. So again, we put a trade on that looked perfectly well. As a matter of fact, yesterday we were right in the middle. This one dipped into our trade, and then it just did an about face. So this has been really the story this week. Price comes right down to our trade and either goes in it or just stops before it and then does an about face 4 times in a row. Yeah, let me show you. We'll go to a bigger time frame. It's a little frustrating. Yeah, so here are the 4 trades. So yeah, here we're coming down, and we take the trade up here, and it's coming down, and it looks like it's going to go to our trade. Then it just takes off, another step up, takes off, another step up, and then just says, sorry, we're not servicing you today, Ernie. That was on Monday. And then this trade, again, took the trade way up here, and it comes down and just about touches us in profit for just a little bit, and then takes off, and then comes down again just to tease us at the end of the day, and then evacuates the area. And then yesterday, we waited until the Fed released their minutes at 2 o'clock, and anticipated that it was going to go up, and so we put our strategy up here and went right up here and just hung out right at the for about half an hour, right at the short strike, short strikes of our fly. Jerome Powell gets up, says some hawkish things, and then whammo, kills it. So this is our week, man. And then this morning, we get this nice continuation dump. Again, we're up here, and so we put our strategy down here, thinking we're probably going to go into the node below. Seems like a fairly, reasonable thing, and it comes into our strategy, and then evacuates the area and never returns. So that's been our week. Yeah, I don't think we did anything wrong, to tell you the truth, and just though that's the luck of the draw. That is the luck of the draw. So in our strategy, because we take such small risks, none of these things hurt us. None of them. As a matter of fact, we could have a mediocre trade tomorrow that would cover all of these trades. We could have a big trade that could completely blow away these losses. All right. So that's the nature of trading asymmetrically. But here, our general analysis has been wrong, I think, 3 times. One of them it was right, but until Jerome came out and said something that was completely unexpected. And so, maybe the strategy should have been wait until after he says something. But, we take such small risk with this trade that you put on a trade for like $100 to make $2,000. So it's, you got to take those bets. You have to take them. And, if any one of these trades had worked out, we would have been up, huge. But they didn't. So we move on. So as I was saying earlier, the way we mitigate our risk here now is this one of those clusters in a chaotic environment that you get these errant trades, or these is this a losing streak that it doesn't, I guess it doesn't matter what the purpose of the streak is, whether it was just dumb luck or just bad analysis. I can understand if it was bad analysis, then maybe you have to do something that would fix your analysis, your analytical methods, and try to put yourself in the right position. But this is how we trade all the time, just put ourselves within a certain probability of touch. I don't really use that as our measure, but usually we put things on that have a certain risk to reward. And with that defined risk, that puts us a certain distance away from the money. And then we have a certain probability that price will come in and intersect our profit grabbing strategy. And, it works 50% of the time. 50% of the time we get in profit, and either we make a small profit, a medium profit, or a huge profit. And that easily offsets the losses, which happen 50% of the time. We allow those to go to 100% loss because they're so small. So when you evaluate something like this, there's no reason to change the strategy. The strategy works. It's just a matter of enduring potential continued losses, because losses come in clusters. Just like wins, they also come in clusters. And so the way you protect against that is by getting small, as I had mentioned before. You don't get there by hedging, by betting bigger and then hedging, trying to make everything back, because that's exactly what I think most retail traders would do. They would just say, hey, I'm going to get back these minuscule losses, and I am going to bet big and get back at it. Now, what happens if that bet big trade goes bad? Well, then you put on a hedge, right, to hedge that loss so that it doesn't completely drain you. But what happens if that one goes bad? Now you have 2 bad trades on, and after a losing streak, and you're doubly in the bucket. Again, none of that ever happens to us, ever. not at all. So what we'll do is we'll just reduce our risk size to a point where it has no relevance whatsoever, but you can still make money. That's the cool part about when you're in an asymmetric strategy. You can reduce your risk size to maybe half or even a third of what you're normally taking, and even that normal risk is still 20 times less than what most other people are taking for risk. So we reduce it even further so that there is absolutely no attachment. We're completely detached from our trades, no problem. But if you win, you still make a fair return. And so that's what we do. And we'll do that until things seem to get back to normal or the chaotic cluster is over. And so that's the way we hedge. We hedge by not hedging. Oh, so someone said it's dropping like a rock now, but I don't see it dropping like a rock. It's got a long rock drop to go before it gets down to our strategy. I just saw that comment. So Sam likes this view. All right, good. Max says it's still dropping, but I don't see it. Guy says, any experience with putting butterflies on both sides of the open at 70% probability of touch? Would seem like one of the two could consistently be a winner. All right, so there's two problems with that strategy, Guy. And we call that the Batman trade because it looks like it looks like Batman's ears, right? And we have employed that. Last year we employed that, but last year was a different market. Last year it didn't matter where you put something, it just made money. The reason why we don't do that is twofold. One is that part of our edge comes from taking these asymmetric trades, the small bet with a large potential outcome. So if you were to put on two of these, then what you're effectively doing is you're cutting in half that asymmetry. All right, so that's the first thing. And so what you're doing is you're moving away from a positive expectancy and making it less of a positive expectancy. The other problem is what happens if price never ends up in either of the strategies, either ear, and ends up right in the middle, right on Batman, right in the middle of Batman's forehead. And now you lose on both trades. So there's doubly bad. So your trades cost twice as much in the best case, or in the worst case, you've lost twice as much. So there you go. All right. Max says dropping like a feather. It's getting there. It looks like it might break through. You know, I'm hopeful. Let's zoom in. Zoom. Still got a long, it's got this whole thing to traverse. Look at it. It's got and there isn't much time left. We only have 15 minutes. I've seen it drop that much in 15 minutes. No problem. No problem. But I don't think that's going to happen today. It'll probably happen after the market closes. So what we'll do is we'll probably come down to about here, right, to tease us. And then the market will close. And then in the futures market, it will continue down. And then it will probably stop. I'm just, this is what normally happens. It'll probably stop right at our center strike overnight and then drift lower into T2. And that's what we'll wake up to tomorrow. So mark my words that that's going to happen. Yeah, Guy. It does sound good. But see, what you're trying to do is do what we're trying to get away from, and that is increase our probability of profit. Because when you're trying to increase your probability of profit, what you're doing is you're reducing your, you're also increasing your risk, and you're totally increasing your risk big time. And that's exactly what we're trying to prevent. We're trying to reduce our risk, make our risk as small as possible for the maximum potential return. So that's all that's doing. All right. Don says he's in position with just 10 more points and he can make some money. Well, that's good to hear. For me, it would have to come down to this green line here, and then I'm making money. So that's quite a drop. But it looks like it might. You don't know. You don't know what's happening. It could be that all of this was just window dressing, and now it's just going to fall like a rock. But I'm telling you, that's what's going to happen. It's going to come down right to about 37.25. Market will close, right in this area, right around here. And then after the market closes, the futures market will take over, and then it will drop further and miss our target completely. I just know it. That'll be fun to watch. So Sam says that weird version of the butterfly that I showed you earlier in Zoom on paper trade went 65 cents to now $2.90 at expiration, will be worth $4. Oh, cool. Also, when the Analyze tab on TOS showed the profit at expiration, if I just leave my butterfly and not close it, it will get the money after market close. Yeah, that's true. I mean, if it has a credit, it will make money, or if it's in the profit zone, it will make money. You don't have to worry about the SPX if that's what you're talking about, or you're talking about the ES. If you're talking about the ES, then yeah, you want to, if you're in the money at all on any of your ES trade, you want to make sure you get out of that. But if you're on the SPX, you don't have to worry about it because that's cash settled. And so there's no assignment in the SPX. There is assignment in the E-mini futures. So yeah, look at it, it's going back up. That was all just a tease. Just a tease. All right, let's go back to the big head. Yeah, so Sam says, yes, that's the SPX. No worries about the SPX. SPX is really a great way to trade. Now, one way that you can get small with the index is to go to the micro index, which is the XSP. And that's about 1/10 the size of the SPX. There you can put on, instead of putting on a trade for, say, $150, you can put one on for like 30 cents or 40 cents or something like that, and still have a fairly good shot at a good profit. And the other cool part about it is that you can put on a wager that doesn't cost a lot of money, but because it's 1/10 the size, you can make it much wider and and give yourself a bigger opportunity. So that's the deal with the XSP, and it is also cash settled like the SPX, so you don't have to worry about that. Unfortunately, the XSP, I believe, only has 3 expirations a week, or no, I guess it has 5 now. It used to be 3, and so that I think that just recently that was changed. Now I don't know if the micro E-mini futures also went to 5 days a week, but that would be interesting to see. So the futures is another way you can go. It's even smaller. I think it's smaller than the XSP, or relative, but it doesn't matter. It's you can put on these small trades when you're in one of these cluster. I was going to see these cluster chucks. And so when you get into one of these clusters of losses, you want to reduce your size, reduce your exposure, get small. That way you can't draw down. I mean, if you're super small, drawing down becomes very difficult. I mean, that's what you want. You want it to be a challenge to be small, to draw down. And then if you hit, you still can make one of those nice little wins. So there you go. Of course, you don't have the same potential that you have with the SPX, but you still have good potential. And it's the perfect hedging strategy. MES is weekly now, is still weekly. So in other words, well, I think the MES, it's 3 days a week. Isn't that true? Or is it just one day a week? Let's look at that. Um, MES. Yeah, that looks like it's weekly to me. Every 7 days. All right. And then the ES, of course, is daily. So you can see that's daily. See, 4, 5, 6, 7, 8. 4, 5, 6, 7, 8. Who do we appreciate? E-mini. All right. And then we have the SPX. Oh, I'm not showing you this, am I? uh, that wasn't good. So now we have the SPX here. See, it's every day of the week. And then we do the oops, the XSP. And it is also, that's fantastic. 5 days a week. The XSP, the micro. And let's take a look at a trade on that. What would that be like? Oh, it's so cheap. Cheap, 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 cheap. So you can see a trade that I specified down here. So that's an E-mini, that's a SP XSP trade. And you know, it looks like it has a long ways to go, but it's pretty far out there. Oh, wow. We're on the move. Maybe I should log into my Fidelity account just in case it makes a fantastic move. I don't think it's going to get down there. What are the chances of that with 6 minutes to go? I did sell my shorts here, so let's see how they go. Um, no, it's still only worth a nickel. It's got to come down quite a bit for the short to work. I'm sorry, for the long. It's coming down though. Can it? Can we get there? It's a race. Look at it go. Yeah, the price isn't changing at all. Why isn't the price changing at all? It's just too far out. I need to get down here. So what did I say though? It's going to close right around here. Did I not say this? It's going to close right around here. And then in the after hours, it's going to go right past our strategy. All right. Man, I mean, it's dropped this far. If it dropped the same distance that it did from here to there, right to here, we'd be in profit. But there's less than 2 minutes to go. It's got to make a bold move. Although we have been online here during our final hour show where we've been totally out of the money. And in the last 30 seconds, it came down and pinned our trade. That was crazy. But I don't, that's not going to happen. Still only worth 5 cents. Yeah. Still over a minute. It's going to be 1 minute very soon. It's not going to drop that far in a minute. It's not just not going to do it. Yeah, see now it's going the other way. I don't know. Can I sell it for 5 cents? Is that worth it? No, it's not. Yeah. So now we got a minute to go. Less than a minute. I'm still sitting here with my finger on the trigger. No, there it is. All right. So it did exactly as I said. Now, for the next part of my prediction, is that in the after hours, I think price is going to come down here. That's my prediction. All right. So Pete Benty wants to know: is there a problem with this strategy with a regular stock? Other than that, you'd have to know everything about that regular stock, and it's not really regular stock is only doing this once a week on Friday. So I originally started doing zero DTE back in 2005 when weeklies first came out on Apple, and that was a great stock to do a zero DTE on back then. So the answer is yes, you can, but there is a problem, and that is that regular stocks are American style options, which means that they can be assigned early. That means that while you're sitting there in profit, you could get assigned with, you could get assigned. Who wants to get assigned? I don't want to get assigned. And you'd have to have 100 shares of, you have to have enough money to cover that 100 shares of stock. So yeah, that's a no go as far as I'm concerned. Jim says it finished right at the pre-market low. That's right, near assigned stock, not cash settled. Those are all bad. And plus, the the early assignment is the other problem. That can be a killer. Yeah, I can't believe it. It dropped that far. It just teased us all day, and then ramped up the teasing right at the end. So, oh well. So let's go back to the big head, and we're back. Um, so today we went over short. I'm sorry. Today we went over hedging and what hedging actually is, who actually does the hedging, and do retail traders actually hedge, or are they just calling it hedging, and what they're really doing is trying to fix an errant trade and usually gets them into even worse trouble and lose more money. Hedging is really for the professionals, the cash buyers in commodity markets or other markets that use futures. We get into futures as retail traders because, well, we're there for a purpose, and that is to not to hedge, but generally our purpose in there is to provide liquidity for all the cash buyers and sellers in the market. That's really the purpose of the speculators. So there are two different classes of people that are in the futures market. There are the cash buyers who actually hedge, and then there are the speculators that pretty much lose money and provide liquidity for the cash buyers so that they have a market so that they can hedge. That's the way it works. We supply our blood and sweat and tears and inject it into their market so that they can live. Yep, that's pretty much it. That's what the futures market is all about. And yes, that was a crazy drop. Woohoo. Yeah, why didn't it do that here? You know? I gotta see if I can point the camera over there. See, why didn't it do that here or here? Then it could have had time and gotten to our strategy, but it had to wait here at the very end. What was the purpose of hanging out up here? There was no purpose to that. It was bull cookies. That was baker's rack. All right. See, now we got a side by side view. All right. Well, here we are. It is Thursday afternoon, 4:05. An day. Last week was like a yeah. This week is like, when is it gonna come back? And so we'll move on to Friday and see how things work out there. I think as we're going forward, the market is going to digest what the Fed has said, their hawkishness. They're now in the mode of, hey, let's see how this settles with the market. If the market drops too much, then we'll put on a Fed speaking tour, and all of the Fed governors will get out there and start trying to form a different narrative, or a narrative that is a little bit softer than Jerome Powell's narrative, which they all agreed to, and then thereby propping the market up. So that, my friends, is the Fed's number one tool, and that is the narrative. The narrative. And if you want to know what the Fed's narrative is and what's going on with the Fed every day, minute by minute, then I would suggest you go to Twitter, twitter.com, and then go to the FOMC alerts channel or Twitter feed. Yeah, let me show you. we need to go to Twitter. Do we have a Twitter up here? Yeah, here's a Twitter. All right, here's FOMC alerts right here. You see that? Oh, what happened there? There's FOMC alerts. Oh, let's move it over there a little bit. Right. And so what I did there is I created an aggregator through, and this is pretty cool. Anybody can do this. I can show you how to do it. But if you want to create a Twitter feed that aggregates any kind of information that you want from the internet that you could likely find with a Google search, you can go to Google Alerts, create an alert, and you can create as many as you want. You can create hundreds of alerts, all say centered around a particular topic. In this case, I'm looking for any mention of any one of the current Fed governors mentioned in any kind of article, any kind of blog, any video, anything. If it finds them mentioned, then it will create a link, and then it creates an RSS feed. Then I take that RSS feed and I feed it into this special program called Deliver It. And in Deliver It, it will take that feed, and then you can hook it up with whatever Twitter account you want, and it will, anytime a new post comes on that feed, it will then, I guess, crunch it up and put it in their own little shortened URL. See here, it's a Deliver It URL and then some code, and then that will point to the original article, right? So there's only 321 followers. There should be thousands. I mean, everybody should be interested in this that trades. But here's one that happened 9 minutes ago. Fed jacks up rates again, but Powell hints it might slow down. Ooh, that's a Politico, because we can all believe Politico. Trust in Politico. So here, see, you can get articles like this up to the minute. As soon as they appear on the internet, they Google finds them, puts them on the RSS feed. The RSS feed gets picked up by Deliver It. Deliver It packages it up and sends it to this Twitter account. Oh, good to hear that, Rob. That was a nice turnaround, down 280 to 132. Frederick wants to know, wouldn't it be better to take slightly higher bets each time you have had a loser, Martingale style? No. Martingale works until then it doesn't. To take slightly higher bets. No, it's the other way around. I don't want to continue with the drawdown. That's the whole point, because the martingale isn't going, that extra that I'm going to get with the martingale isn't going to materially affect me. I'd have to increase the width in order for the martingale to work, and the cost is prohibitive. I wouldn't do it. No, I can't see doing it. All right, so this article here, it's kind of hard to see, huh? I don't know. What happens if is it too bright? Let's dim it a little bit. Can I dim it? No, I want to dim this one. Yeah, like that. There, now you can see it. That's better. So Fed jacks up rates against Powell again, but Powell hints it might slow down. When did he hint that? Did you hear that out of Powell's mouth, that he was going to hint that it might slow down? I mean, that's why the market went down yesterday, because he said, no, we're not going to slow down. We're going to put pedal to the metal. When Politico, I thought you always tell the truth. See? This is just a repackaged story, by the way, that gets put out by Politico and then other left-leaning sites. What they're really trying to do is they're trying to prop up the market because the election's coming and they're in dire straits. I'm pretty sure that's why. All right, so that's that. Let's see if there are any other good stories here that we can pick up. Did Jerome Powell just bust the market rally? CNN Business. Well, there's a trustworthy source. Let's go look at that. Did Jerome Powell, did Uncle Jerry just bust the stock market rally? And this is from London's CNN Business. Federal Reserve Chair Jerome Powell has the power to make or break markets these days. Way too much power, in my view. On Wednesday, he opted to disappoint. What's happening? The central bank announced its fourth straight interest rate hike of 0.75 percentage point, continuing its aggressive and unprecedented campaign to get inflation under control. They want to get it down to 2% because that is the magic number. 2%. What investors honed in on, however, were Powell's comments about where interest rates could peak and how long they could stay there before the Fed changes course. All right, so are they saying, okay, so he busted the market. So they're not saying that he made inferences that they're going to slow down. All right, let's continue on here. I think that this could be interesting. Yeah, see, Don's saying the same thing that I thought. He said, did not hear that at all. They're putting words in the mouth, or they're just copy pasting from others and don't know what they're saying. I agree 100%. Yes, that is correct, JP Swede, with the martingale. You increase your bet after each loss, guaranteed to be a winner if you have unlimited funds. That's the only way. All right. The question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive. Powell told journalists. The Fed, he said, may move higher to higher levels than we thought. What did they think? What was their initial speculation? Because, virtually every speculation that Jerome Powell has made on inflation has been 100% wrong. Every single time. Right? Every single time. First, they thought, well, at first they were talking about interest rates were not hot enough. They were too low. They were worried about deflation and they needed to get it up to 2%. And then they overshot 2%. And they thought, then they started, and it kept on going, and they said, oh, well, that's just transitory. Transitory was the word for a long time. It's transitory. Transitory. It's just going to go up, and then it's going to come right back down to 2% because we can will it there. And then, of course, Janet Yellen also chided in with that, as well as the administration and all the news agencies, and transitory was the word of the day. Everybody now added transitory to their vocabulary. They were speaking transitory every other sentence. All right. So then, after transitory became no longer de rigueur, it became the swear word, and they realized that they were wrong. Oh my God. They started talking peak inflation. Peak inflation was the word for quite a while, not quite as long as transitory. Transitory still sticks in the craw of certain traders and pundits. Transitory. Yes, of course, everything is transitory given enough time, correct? But I think in this context, they were thinking transitory in the context of months or quarters. So now we're wondering if we're going to hit peak inflation, and every time we hit another peak, they say that this was the peak, And then we hit another peak, and they say, well, no, this is the peak. And then we hit another peak, and say, no, well, this is the peak. So first it was, this is the peak. And then it was, this is the peak. And then it was, this is the peak. And then it was, this is the peak. So we've gone through all of those variations of peakness. And here we are now. Now they're talking about using their tools to drive down inflation. They are going to pull a Paul Volcker. They're going to do a Volcker and put their jackboot thug boots on the neck of the economy, drive people to the streets. I'm sorry, into the streets, so that they can get inflation down to 2%. That is what they're going to do. And then, of course, in the meantime, Janet Yellen, the other brilliant financial wizard that we are so lucky and grateful to be adorned with, Janet Yellen, the stupidest Fed chair ever. And so therefore she needed to be promoted to Secretary of Treasury, because that's what happens in a Dilbert world. That's what happens in an opposite world. She is now Treasury Secretary. She wants to usurp power from the Treasury because she did such a great job there and become an additional central bank. She wants to buy and sell treasuries in a very granular way in order to affect the markets in a way that the Fed cannot do with their big hammer. She's going to use little screwdrivers and screw us. Because Janet Yellen, we can all trust her, because she was also wrong at every step of the way. In fact, she doubled down on the wrongness. And so now we have to look forward to that. So that's where we're going. That is where we're going. The Fed. I mean, wouldn't it be wonderful if we actually had a stock market that you could, well, I mean, try to analyze based on the meritocracy of companies? Oh, wouldn't that be something? That would be awesome. Imagine apportioning your bets and your risk based on which companies are better than other companies, not on the fictitious rates and damage that the Federal Reserve and the Treasury do in our Keynesian world. All right? That would be good. That would be really good. But anyways, I think I've said enough. Hey, look, if you like this video, give it a thumbs up, please. And check us out tomorrow. We'll be here. Peace to you all. And now it is time for the music.